Hello traders, Gary Wagner here, 1237 in Honolulu, 537 in New York on Thursday, February the 3rd, 2022, and this is the Daily Report for gold and silver. An extremely volatile day with major price action, with gold opening at 1807.40 and then trading to a low of 1788 within the first half hour of trading today. We did put on a trade. We will cover that in detail when we pull up our charts, but gold is currently fixed at $1,805.20, a net decline of $5.10, or about 0.25%. All week we have been speaking about the benefits gold has been receiving from this major price decline in the U.S. dollar, curtailed any major price decline. The dollar index lost 0.6%, 58 points, and is currently fixed at 95.335. However, even with dollar weakness, silver lost 1.24%, 28 cents, with the most active March contract currently fixed at $22.42. This first chart is a 10-minute candlestick chart, marking out the New York Open this morning, as well as our entry price for the trade alert we sent out this morning. First of all, I do want to thank Conrad, who is our Chief Technology Officer and trading counterpart in Europe. The fact of the matter is we have 24-hour trading with gold, and without having entities in both the United States as well as Europe, there is no possible way that the market could be covered. As you know, all week we have been looking to position ourselves from the long side and send out a trade alert accordingly. We did have a target in mind of where we wanted to get in, and we were able to facilitate that today. We entered our trade at 1790, and what's most impressive about that is the fact that market traded pretty flat as it traded overseas. Upon the open of New York, and that's this arrow here, within a 15-minute period, we saw it decline from the open of 1807 down to these lows at 1788. We were able to enter at 1790. Initially, our trade alert recommended placing a stop at 1775. However, we sent out an adjustment to that to move the stop, if you had placed it at 75, to 1772. What is so amazing about today and the extreme volatility is while we did get in really close to the bottom, within the next hour of trading, the market went back to the open, actually surpassed it, and then is currently fixed, as I said, at 1805. As you know, we entered this trade based on two primary reasons, one technical, the other one fundamental. We spoke about the fundamental reason yesterday, and that was an alarming jobs report by ADP, projected to come in with a positive 200,000 jobs added in January, with the actual numbers coming in with over 300,000 lost jobs. We believe that that could reflect in tomorrow's Labor Department jobs report, and that could have very bullish sentiment for gold. We'll have to see. The second component to enter the trade was strictly based on a technical set of studies that we have been looking at. Most importantly, the fact that we have seen gold since August of last year consistently trade with higher lows and lower highs has formed a compression triangle. We also saw that we were getting close to the apex, and as it approached the bottom of the range, that would be the best possible of entry prices. Elliott Wave viewed compression triangles a little bit differently. He called it a symmetrical triangle, and it occurs as a corrective wave, whether in a downtrend or an uptrend. In this case, we're drawing it as an uptrend. And we are using that template to define what we're seeing in the market right now. This corrective pattern can be defined as a series of lower highs, higher lows, and a 5 wave count, or as he calls it, legs, this being 1, 2, 3, 4, and 5. And the major component is that on the fifth wave, it will break through resistance and create what he calls a thrust, which is the moment that it does break resistance. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekend review after the jobs report. Have a great day. Bye-bye.